So what we're going to do to calculate the long-term interest rate is to go back to the first quarter's financial statement. So we need to refer to the winter quarter financial statements. And I want you to find the dollar amount of the long-term interest for the first quarter. It's in the occupation cost section of the statement of income, below the operating profit, and the first quarter long-term interest dollar amount.
$11,813.
Correct. $11,813. We can perform this calculation only once because of the way that interest is being paid on this loan. Interest is being paid in what's called arrears. We borrowed principal, and the first payment is being made at our place at the end of the first quarter. So we know what the beginning principal balance was on the long-term debt. Reflect back to the opening day chronology, or take a look at the long-term debt portion of your balance sheet. There are two accounts associated with the long-term debt. It was the mortgage provided by the private investor in the amount of $305,000, plus the $80,000 worth of leased equipment, the capitalized lease. That lease has an implied interest rate associated with it. So, the principal portion, or P value of our interest rate calculation, equals $385,000. That was the beginning principal balance on opening day at our place. Over 91 days, interest accrued at a rate that we're going to determine that resulted in a total long-term interest payment of $11,813. So R is going to be the variable that we're trying to solve for. And we know that T equals 0.25 because the financial statements are being constructed on a quarterly basis. Interest rates, again, are always reflected on an annual basis. So we can proceed with the calculation. Simple algebra. $11,813 is equal to $385,000 times R times 0.25. First step in our solution is to simplify the right side of the equation. And $11,813 is going to be equal to 25% times $385,000 times R. So 25% of $385,000 equals $96,250 times R. To solve for the interest rate, we have to divide both sides of the equation by $96,250 to isolate the variable, which is the interest rate. And in so doing, $11,813 divided by $96,250 is equal to a long-term interest rate of 12.3%. Rounded slightly from 12.2743 and some other numbers. So 12.3%. That's the long-term interest rate associated on the combination of long-term debt at our place. Now, while we're looking at the long-term interest expense, compare that to the long-term interest expense on the spring quarter statement of income. And in so doing, you'll note that it's less. In fact, let's record the interest expense for each quarter. First quarter, we just looked at $11,813. Second quarter, $11,621. The third quarter, $11,423, and the fourth quarter, $11,218. So we notice that the interest expense over time is decreasing. Why is it decreasing? Well, every quarter we make a payment on the principal portion of the debt. The interest rate is fixed at 12.3% for the life of these loans, but the amount of money that we owe at the end of each quarter is reduced, and therefore the long-term interest expense for each quarter is a little bit less. To calculate the return to the owner's investment, we are going to take the EBITDA less the return to the lender, which is the interest. Remember, the EBITDA is an annual number, so if we sum the total long-term interest payments for the year, we'd find that $46,075 have been paid to the lenders long-term for the use and enjoyment of their money. The balance flows to the owner. So to calculate how the owner is doing, we are going to look at the return on equity, which is a way of expressing the return on the owner's investment. The annual EBITDA of $114,224 less the annual long-term interest that's been paid to the lenders of $46,075 equals an operating cash flow to the owner of $68,149. Now, we're using this operating cash flow term a little bit loosely. It really is what's remaining of the EBITDA, which is a significant component of the operating cash flow. But recall from our statement of cash flow construction earlier in this program, it also included some balance sheet account value changes, accounts receivables, inventory, and accounts payable that we are not including in this calculation here for simplicity's sake. The ROE percentage then is this operating cash flow of $68,149 divided by the owner's investment, $150,000. Dividing that numerator by $150,000 equals a return on the owner's investment, or a return on their equity, of 45.4%. The lender's return is 12.3%. The owner's return is 45.4%, significantly higher, but significantly more risk associated with their investment. We're now to the point to take a look at how these returns are related in a concept called financial leverage. The return on net assets must lie somewhere between the return to the lender, which is 12.3%, that's the interest rate, and the return to the owner, which is 45.4%. Reflecting back on our prior calculation, the return on net assets was calculated as 21.3%. And notice that it does lie in between the return to the lender, 12.3%, and the return to the owner, 45.4%. Note that the return on net asset percentage is weighted toward those who contributed the most, which is the lender. The lenders contributed the majority of the fixed assets, recall $385,000 of the $555,200, and the owners contributed the remainder of the fixed assets of $150,000. So the return on net asset percentage of 21.3% is closer to the lender's long-term interest rate of 12.3 than it is to the owner's 45.4 return. ROE also equals return on expectations, as I like to say. What do lenders expect? Well, they expect a return on net assets of approximately 2 to 3 times the long-term interest rate. Recall that our calculated return on net assets was 21.3%, a little bit shy of 2 times the long-term interest rate of 12.3%. If it's lower, they probably won't contribute. So your business plan has to make a case that the assets are going to return more than the long-term interest rate, approximately 2 to 3 times more. What do owners expect? Well, owners expect a return that's commensurate with the associated risk. The restaurant industry is perceived to be a high failure rate industry, and in light of that high degree of risk, owners' returns should be substantially higher than the lenders' returns. What's the end result of a well-executed business plan? And this is the conclusion of our program on the business of restaurants. Well, revenues need to exceed expenses. And that's the interplay between management's marketing plan and the execution at the operation. Revenue, if you recall, is a responsibility of the guest. No guests walk in the restaurant door, no revenues are generated. It's management's marketing plan that encourages the guest to participate in this interplay. Cash inflows exceed cash outflows. Recall that profits don't equal cash and that cash is necessary for survival. So even a restaurant that's generating a profit on the statement of income could have negative cash flow and be a candidate for failure. Don't confuse profits with cash. The return on assets exceeds the cost of borrowed capital. When the return on assets exceeds the cost of borrowed capital in a sufficient multiple, approximately 2 to 3 times, the financial plan fulfills the promises. We're able to pay the interest for the use and enjoyment of the lender's contribution and the principal portion of their original contribution. And lastly, the return on equity exceeds other investment alternatives, and that is the answer to the owner's prayers. That concludes our presentation on the business of restaurants. We hope that this enhanced understanding of unit-level economics makes you better prepared to be a success in this exciting industry. Thank you.